So glad to be here, Mariana. And my name is Nitin. I currently serve as Director of Financial Sciences and Digital Assets. I've founded the Blockchain Labs, as Mariana mentioned and introduced. And after that, I also founded Digital Asset Lab. So I've been in this space since 2012. So many of you can understand the blockchain space. It's eternity, the entire decade. And lately, in the past, I would say about 2 years or so, I've been heads down on decentralized financing, understanding the entire space from both protocol, which is technology perspective, and attempted to draw some similarities between how I had witnessed, for example, the monetization of internet and how the companies over internet evolved unto the point where we begin to see as to where Amazon is today and what transpired between the origination of internet. And so I'm trying to draw the same parallels with that industry to where we are with blockchain and evolution of various protocols and impact of those protocols from a perspective of, where we are trying to achieve this from what is the next unicorn in the space. And decentralized financing sort of presents a very unique opportunity for us to be able to understand not just the transformation of the industry itself, but also the disruptive elements of the industry. So I had just a few slides to make the point. There's a paper behind each of the slides, which I have published via my LinkedIn profile. So I invite you to connect with me and have that open discussion because it's still a very nascent space. What I've also done in the past sort of few weeks is looked into discerning between why DeFi and why now. And in some cases, we've looked into figuring out as to what is the uptake from the traditional industry players, what are the element of asset tokenization in the space, and what does blockchain as a transaction system do? Because in many cases, there are regulated industries, but in many cases, there are asset class-based regulation that we had to understand. So I do look into liquid and illiquid assets. We look for liquidity into illiquid markets like private equity. And we truly believe that many of the elements of the new asset classes, as well as what technology enables this to happen to as a global marketplace, is really trying to amalgamate and bring liquidity to illiquid markets, but at the same time, trying to create new asset classes, which I will share a few examples with you in this. So I took this, and there's a paper behind this, like I mentioned earlier, looked into understanding what is how do you make money in this space? How do you commercialize the protocol space, which has been evolving now since 2009 timeframe, and it's become, today it's 1.2 trillion or so of total sort of valuation of the entire market in general, which is crypto market, which it has various classifications around it. And so I looked into and studied, say, you had layer one protocol, which is basically the foundational layer, Bitcoin, Ethereum as an example. You look into layer two, which is tied to layer one, making layer one more efficient, whether it's from security or from scaling the platform better, creating side chains or lightning networks, which enables and enhances sort of the bilateral transactions from a perspective of safety and security. And then you begin to see a lot of layer three protocols, which is things like ERC20, which is asset tokenization frameworks, verification, validation, identity, which is going after providing sort of support services for real business to happen. And from an opportunity perspective, I think layer four brings it all together. And that's the unicorn that I'm really focused on in understanding as to what are the business applications, what is the sort of the next generation of Amazons and Baidus of the world who are trying to capitalize and eventually roll up the protocol layers that goes into it, which means that the entire economic system that today relies upon the incentive economics of blockchain itself is trying to understand how each layer sort of, which is intertwined, is leveraging the underlying layers. And again, I draw an analogy between how internet evolved. And while I may be dating myself here, in early days, you realize that there were a lot of companies who were fairly well valued in terms of providing an operating system, providing protocol compressions, charging for emails, for example, and all that has gone away only because now we have a different economic system, and now we have the rise of e-commerce and e-platforms that are making business happen. And so I've taken those things, and I also looked into how token-based models and how does the industry monetize the space. And so what you see on the right-hand side is typically how the industry has taken the effort to monetize the entire space. And then comes DeFi stack. And this is the meat of what I want to talk about with you all today, is looking into and understanding decentralized financing. So while the previous slide talked about technical evolution of blockchain, given the fact where we are today, a decade later, almost a decade later, after the advent of Bitcoin and after a few years later, Ethereum, a lot has happened in the industry. But if you simply were to understand the decentralized financing space, you look into crypto liquidity, which is the foundation layer here. We look into digital assets, which is the second tier, which provides some level of asset tokenization mechanisms, which provide fungibility, stable coins, looking into tokenized assets, non-fungible tokens, for example, things like collectibles and what you may have heard with crypto, crypto kitties and so on and so forth. And then comes the real interesting part, which is what we're dealing with: lending protocols and the collateralized debt positions, the DEXs, the decentralized exchanges, these synthetics or central bank digital currencies are sort of evolving there as well. And then again, the notion of capital formation, which is, instead of going through an expensive IPO route, how do we leverage the technology and the fundamentals behind it that allows you to be able to create this ecosystem, issue digital securities, manage the cap tables, raise funds, move those funds as payment instruments, and use those payment instruments to be able to form companies and report the profitability and the status of those companies. And the last layer again here is the niche sophisticated services, what you may have seen with yield aggregation, protocol interfaces, non-custodial finance. These are very, very niche, highly risky, and not well understood capabilities, but we have to understand the entire stack nonetheless. And what you see on the right hand side is sort of the decentralized financing support vertical, which is providing adjunct services, things like tax and KYC and AML, all the things that are required for a functioning economy and functioning marketplaces. And we begin to see this evolve at a much rapid pace. And again, comparing to what has 5 years now, given the fact that there's almost about $1.2 trillion in collective sort of, whether it's token valuation or crypto native valuation, that's trapped in this in this ecosystem, I think is very, very attractive. So while this is happening in the decentralized world that's trying to disrupt the existing financial establishment, we begin to see, this is something which is in 2020 alone. So this 2020 year, this is from Block Research. 2020 has been an amazing year. I've been personally involved in many of these projects where you suddenly look at a lot of, especially the regulators stepping up and issuing interpretive letters. You begin to see the incumbents and the fear of disruption, but also trying to embark on an opportunity area: Visa, MasterCard, and Financial, JP Morgan, Goldman Sachs. You begin to see now a trend where what we have anticipated about 7 or 8 years back, and I had publicly talked about this, is a convergence of that world. Convergence where the crypto native world and the decentralized financing has become so attractive and so efficient, which has not only tried to address the inefficiencies of the market, but also try to address some of the elements that needed to be, introduce new asset classes, but also introduce efficiency in the system. And you begin to see all these big players jump into it. And I think that not only provides some level of legitimacy to it, but also provides a perspective where this public infrastructure called blockchain and which is led by many of the underlying protocols we discussed earlier, provides an avenue for many of these companies to exploit, grow, and harden that infrastructure, similar to how the internet or the current day internet evolved. And so from this perspective, I just quickly want to end with one slide, and I'm happy to engage in additional conversation. From my perspective, and I've been focused in this space, or at least this slide, I've had this slide now for almost about 3 or 4 years. I still think that these 6 focus areas, which has been my focus areas, still needs a lot of work. We still need to understand digital identity, because if you're dealing with digital assets need to, you can't assign digital assets to a passport or a driver's license. You need to have a digital version of that, whether it's a passporting entity or whether it's a sovereign issued identity. You still need a digital fiat, which is where the CBDC and stablecoin have filled in the gap and filled in the conversation areas. where you still need to address a fungible unit to solve the last mile problem in terms of a payment instrument. And I think asset tokenization, while it's still a focus, it's an area where ERC20 and ST20 like frameworks have evolved. But nonetheless, I think when you start looking at the physical assets, we do need to understand that a token needs to have some level of integrity if it's tied to a physical asset, and we still need to work on some of those areas. And the bottom three are mostly business and technical challenges. We do need to address the cybersecurity challenges, only because while blockchain presents a parallel network, it still relies upon the existing protocols. And the remaining two is, if you don't have a business model, then you're gambling in most cases. And if you don't have a business model, then you're not able to exploit the promises and the value of these emerging technologies and the networks these facilitate. And of course, governance model is important, because in most cases, if you're exchanging value, you're under some purview of some regulated entity, and you need to understand what that is.